I'm the CEO of an AI software development company, and we've partnered with the leading CPA firm nationally for the tangible property regulations. The table that you see shows the tax deductions we secured for 5 clients using the tangible property regulations, and these can be combined with cost segregation to create extraordinary value. We consider the TPRs to be the most underutilized real estate tax solution. Our mission as software developers is to empower CPAs by providing them AI software that simplifies the process of securing tax benefits for both their real estate and business clients. The best 3 property types for TPR are buildings valued over $10 million that have been owned for at least 5 years, buildings that have been sold or were recently part of a 1031 exchange, where a significant portion of the investment was capital expenditure, CapEx. Value-add buildings undergoing major renovations. Our CPA team has authored over 1,500 pages for the publisher CCH, secured $750 million in TPR income tax deductions, and given hundreds of CPA seminars for CPE on the subject of TPR. On our website's homepage, you can listen to a brief, popular podcast on TPR with key takeaways. You can listen to it on your smartphone as well. Our 48-page ebook on TPR, which has a core of 18 pages and a list of 56 TPR questions with links to the answers, a 20-page brochure, and 2 flyers. The TPRs were enacted in 2014 and clarify what can be expensed versus capitalized and depreciated. It allows you to optimize write-offs of building improvement expenses, thus reducing NOI and income tax. TPRs enable property owners to save millions of dollars in income tax by increasing write-offs permanently, lowering the basis of the property, and reducing depreciation recapture tax at the time of sale. As in all IRS codes, compliance is vitally important and not optional. The IRS requires annual TPR reviews of depreciation schedules to eliminate improperly capitalized items. Penalties for not complying with this requirement can lead to rejection of depreciation claims, significant financial losses, penalties and interest charges, and audits. Mandatory compliance since 2014 is annual scrubbing of depreciation schedules. Want proof? Download the 265-page IRS TPR guide for IRS auditors from our website or our PDFs. Can you do a TPR and a cost segregation study on the same property? Often, yes, and it's advisable. The question is, which one comes first? So TPR is mandatory annually, scrubbing depreciation schedules. Cost seg is optional. TPR studies usually come before a cost segregation study. And if you have not done a cost seg study, otherwise 5 years after buying a property is when you would do TPR. A look-back TPR on a property that already had cost segregation, many of the previously capitalized items, which are going to be depreciated, can be reclassified using TPR as permanent expenses, which is better than depreciation. Cleaning up or scrubbing a depreciation schedule can save millions of dollars in taxes. Generally, about 80% of CapEx can be expensed through TPR. We'd like an opportunity to demonstrate the kind of tax refunds we can find for you. To receive a no-cost, no-obligation TPR analysis from our experts, it's very, very simple. Step 1, email us a depreciation schedule for a building you have owned for at least 5 years, valued at $10 million or more. No tax returns are needed. Step 2, we will analyze that depreciation schedule to reclassify expenses and find the tax refund you should have received using TPR at an expert level. This can be retroactively added to your bottom line. Step 3, we will fill out IRS Form 3115 to explain the changes in your accounting so you can file for the tax return. Our look-back analysis will validate. Thanks for watching. This is the final slide. We have hundreds of references, and audit protection is offered.